If you have questions, please, you can raise your hand. You can enter the question in the chat. I have some topics that we've run across frequently asked by our new business clients or people starting new businesses, and we're gonna cover those, but that by no means is all we can talk about. So that's me without the cowboy hat. I don't know. I think I look better now, but. So let's dive into the first question we get a lot, which is tax structure. So a lot of people come to us and say, I don't know whether I want to be a corporation, an S corporation, a partnership. I don't know what the difference is. So just a little foundational information. The IRS allows you to be taxed one of four ways. Well, that's not entirely true, but for purposes of our conversation in your business, there are four. The first is sole proprietor, and that's the default when you start a business. That's just, I am an individual, I am running a business. It doesn't matter if you have a separate bank account, a business name, none of that matters. If you are in business and you don't make a positive election to do something differently, you're going to be a sole proprietor. That is going to be taxed on your personal tax return on the Schedule C. There is no separate business tax return to file. The other options are two different types of corporations and partnerships. There's a lot of confusion from folks when they come in and they're saying, well, how do I file an S corporation with my Secretary of State? Well, you don't. You file either a partnership or a corporation with your Secretary of State, and then you go to the IRS to make an election of how you want to be taxed, which is a separate thing. So again, the state doesn't care how you're taxed generally. I mean, for purposes of filing the entity, but the IRS does. So you have a C corporation, which is basically your default setting when you form a corporation. If you form ABC Inc. with the Secretary of State of Oklahoma, your default status with the IRS is as a C corporation. You can be an S corporation, but it requires you to elect to be an S corporation with the IRS. An S corporation has some benefits. We'll talk about those in a second for small businesses, but there are limitations on who can be an S corporation. Generally speaking, it has to be fewer than 100 owners, and they all have to be U.S. residents. The fourth option is partnership, and partnership is not something we see a lot of in small businesses, but it does have a place. The circumstances where a partnership might make sense is if your primary business is real estate, or if you have a partner that is contributing money, like a silent partner and a working partner. So somebody's putting in the money, the cash, and the other is doing the sweat equity. Those would be the place where a partnership would make sense. So the question I have here is, what's the default tax status for an LLC? And that's a great question, because pin that for a second, because I'm going to get to it. So you form this entity with the Secretary of State, and you want to file with the IRS and tell them, I'm in business, I want to be taxed this way. You do that two primary ways. The first thing, and I have it out of order here, the first is to obtain an EIN. That's an employer identification number. You need this even if you're a sole proprietor. And a lot of people I see don't obtain this, but it's best practice to go ahead and obtain an EIN, even if you are acting as a sole proprietor and don't have a separate legal entity. You can do it online. The URL's there. I will be sharing these screenshots, so you'll have it in post attendee email, so you don't need to write it down. But it's a fairly simple process, except that, I mean, I say it's simple in that it's user friendly. It's not simple in that the IRS asks you a bunch of questions online, and that's where people get screwed up. So if you choose to be taxed as a partnership, well, no, let me rephrase and I'll answer this individual's question. If you choose your entity type, that's one of the questions you have to answer is you've got to put in the name of the entity. And if it's an LLC, you select that button and say, I'm an LLC. The default is going to be partnership. That's the way the IRS views it. Now, that doesn't mean you have to be taxed as a partnership. But what I'm saying is if you go in to do your obtain your EIN online and just bebop through with the defaults, it's going to tax you as a partnership. So that's the part about obtaining your EIN online that is not simple. So I've seen a lot of people not completely screw it up, but not get the intended result when they go online and do that themselves. If you choose the button S Corporation on obtaining that EIN, they'll give you this little notice and say, that's great, you need to file an additional form. And they're right, you can't do that online. It has to be a wet signature for the IRS. It's Form 2553, and all of the shareholders of the corporation or the LLC, and I'll come back to that, have to sign that form. Now, I said that the state didn't really care how you were taxed when you're forming it. The IRS, on the other side, doesn't really care when you're starting what kind of entity you have, all right? So if you have a corporation or an LLC that you formed with the state, you can choose to be taxed as a C Corp, an S Corp, or a partnership. As long as you make that election up front, they don't care. So I know that's a little confusing, but an LLC can be taxed as a partnership, a C Corp, or an S Corp, but you have to choose. Now, one of the more common questions we get is, I'm operating as a sole proprietor. I've been in business for a couple of years, or maybe I'm just starting out, and do I need to form an S corporation? I'm not going to talk about the legal aspects of why you would want to have a separate legal entity. Although I will say in general, it is best practice, because as long as you do it right, you're keeping your business assets separate from your personal assets, and the business liabilities separate from the personal liabilities. So in other words, if someone sues your business, you're not going to lose your home if you structure it correctly. So going back to this S corporation question, I think it's easiest to give you a visual example. So let's say your net income, this is not your top revenue dollar, this is after you've deducted all of your expenses, you have $50,000, and you're a Schedule C or an S corporation. Either way, you're going to pay income tax on that amount at your individual tax rate. And of course, your individual tax rate depends upon what else you got going on. Spouse works, rental property, whatever. But for purposes of this illustration, it doesn't matter, because that $50,000 for income taxes from your business is treated the same for a Schedule C and an S corporation. Where the difference is in what is subject to self-employment tax. Okay. Now, self-employment tax is a tax that the IRS assesses on individual business owners that is the exact same rate as the FICA tax rates in a business for an employee, which equals 15.3%. So in a Schedule C situation, that $50,000 is going to be subject to income tax at whatever rate that is, plus the 15.3% self-employment tax. The strategy that we like to implement with the S corporation is to set up a corporation, make the S corp election, and then put the owner on a W-2 wage. What that does is that wage is all that is subject to the FICA tax, the same rate as the self-employment tax. So in this case, the $50,000, that's going to be taxed at whatever your individual tax rate is. But you can see here, the self-employment tax or the payroll taxes are half. So that's a big difference. The question invariably comes up, well, why do I have to take a W-2? I'll just take 0. And that's a huge red flag with the IRS. That will get you audited quicker than pretty much anything besides not paying your payroll taxes. The wage that the IRS says that you have to pay is a reasonable salary. Now, I won't go into why they use that terminology and all the court cases on it, but I use the phrase, pigs get fat, hogs get slaughtered. You can't do something stupid. If you're making $250,000 profit in your S corporation and you're not taking any W-2 wage, they're going to slap you silly. I don't remember. It's probably been 20 years ago. There was a presidential candidate that was a lawyer by profession that had an S corporation, and come to find out, in all the campaigning, he hadn't been paying any W-2 wage to himself. So he had like millions of dollars that he was skipping out on this payroll tax. Needless to say, he had to drop out. So you have to do a reasonable compensation. And my best advice on this in general is, what would you have to pay someone else to do what you do in the business? And that's a good starting point. Let's go to the next slide. So one of the questions we get routinely is, what software should I use? What accounting software? We have people come to us that are using spreadsheets, Google Sheets. There are all kinds of ways you can do your record keeping. I've listed the 5 most popular accounting and bookkeeping softwares on the market, and I'll go into a little more detail here, but QuickBooks is the 800-pound gorilla in the marketplace. I don't know their exact market share, but it's huge. The other 4, is that 5? 4 that are listed there, combined make up maybe 20% of the market. So, and I'm going to tell you, we're here at Core, we're agnostic. We don't care what bookkeeping software you use. And I think after I walk you through this and show you the differences, you're going to realize that it really doesn't matter. Some are a little easier to use than others. Some are a little cheaper than others, but at the end of the day, they're pretty much the same. For startup companies. Now, I'm not talking about every business. I'm just talking about startup businesses. I skipped over that first statement, which is separate your bank accounts. So I don't care if you're still operating as a sole proprietor, you need to have your business in a separate banking account. There's a couple of primary reasons for that. First is it's really hard to keep good financial records if you're trying to do it out of 2 different accounts. And in that one account, you've got business, and then this other account, well, I've got some business and I've got some personal, and it's hard enough to do your bookkeeping without complicating it. So have a separate bank account. The second thing on that is, as far as having a bank account for your business is, if you are audited by the IRS, you don't want to turn over your personal bank accounts to them. And if you are running your business out of it, they're going to want it. And then they're going to start asking a lot more questions, and they're going to question your deductions. It's just not good. It may cost a little more to have a separate bank account for your business, but you got to have a separate bank account. So I put this URL up there. This was last November. NerdWallet did a comparison on the different accounting softwares, and it's solid. It's solid recommendation. You can look at that to compare the other four besides QuickBooks. QuickBooks has, this is straight off their website and their pricing. They have a even cheaper version than the Simple, which is I think $750 a month, and I think that they call it Startup or something like that. But if you look, the main difference is your ability to pay your bills, which you can do through your bank for free usually. And then going up to the plus is the ability to track inventory, which few businesses do now. So I think most startups can say in the bottom two. I think you could be just fine in the Simple Start and not worry about it. Now, all of these options are online. To buy QuickBooks and install it locally on a computer is next to impossible because they discourage it. But they do have some versions of QuickBooks. For instance, if you're running enterprise, I know the point of sale system has since been moved to the cloud, but everything as far as Intuit is concerned, all of their development dollars for several years have been going onto the online. So, desktop, I wouldn't even recommend it. And then this last option that they have is really more about the integration with other software. So like if you use Shopify or, some other software that you want to tie into QuickBooks, you're going to have to buy the more expensive version. When it comes to integrating other softwares with QuickBooks, some make it real easy, some make it very difficult, and some are just complete disaster. So just be cognizant of that as you're picking a software. You may not want to integrate it. It might be easier to just do it manually, because again, what we're trying to do in QuickBooks or Xero or anybody else is we're just trying to keep the business records. We're not really overly concerned about customers and products and those types of things. So taxes. We talked a little bit about income taxes and the entity selection, but what other business taxes are there? I'm going to skip the first and come back to it, the first two items. So there are payroll taxes if you have employees or if you are an employee. I mean, you're treated just the same as you hiring somebody else. I don't recommend any business owner, however small, tries to do their own payroll taxes or run their own payroll. There are tons of inexpensive options out there, and the risks are just not worth the risks are not worth the cost savings of trying to do it yourself. They monitor, the IRS monitors and collects payroll taxes extremely aggressively. If you look at their enforcement and their collection efforts, it's, as far as the small business sector, I don't know the percentage, but anecdotally, I'd say it's 80% of their efforts go into the payroll taxes and collecting those and making sure that they're filed properly. So my statement on payroll is don't do it yourself. Most states have a sales tax. Many states tax services as well as products. It varies very widely by state. That is determined at the state level. The rates, however, are determined down to a state, a county, and a city level. So, I'm sure I'm not telling you anything you don't know. You've bought stuff in different geographies. The sales tax rates are different, even within the same state. As far as you as a business owner collecting sales tax, you need to confirm, even if you're selling a service and not a product, that your service is not subject to sales tax in your state. If you are required to collect sales taxes, virtually all states allow that to be filed online and paid online. But making sure you're collecting the right rate is critical. And especially if you're in online sales, there's an issue of making sure you're dealing with the right rate. I'll say a little bit about that, is that the intrastate sales, so like if you're in Texas and you're selling into Ohio, do you have to collect sales tax? Well, one, is it taxable in Ohio? It's not whether it's taxable in Texas. So your product or service that if it's a product, it's subject to sales tax. But if it's a service, you need to determine whether it's taxable in the state of your customer. Now, most states have this free harbor where if you don't sell X dollars into their state in a given year, you're not subject to collecting sales tax. So most new businesses, unless they're an Amazon reseller or they're an online retailer, are not going to run into multi-state sales tax. But understand that it is out there. It is something that the states have been pursuing aggressively as their budget shortfalls. Going back to quarterly tax payments. So an individual taxpayer, their tax is due every quarter. Now, as an employee, you didn't have to worry about that because it got withheld every pay period. So you don't need to worry about it. But the way the IRS looks at it is they bunch your income into 4 quarters. It's not exactly 3 months. Don't ask me why. They want the tax for that quarter paid in that quarter. If you don't, there's a penalty. It's not a lot, but there is penalty and interest if you don't pay it quarterly. I will tell you that most small businesses don't make quarterly estimated tax payments. And a lot of them, their first time around, they're surprised when they get to April 15th and they've got a big tax bill. I would suggest making quarterly tax payments. Alternatively, if you are taking a W-2 out of your company as an employee, you can manage your tax withholding through your payroll and do it that way instead of quarterly tax payments. So what percentage? How much do I need to withhold? Well, if you're a self-employed individual, let's take that previous example where I said $50,000. And let's say you're single, you don't have any other income but your business, and that $50,000. Well, from an income tax standpoint, you might owe $2,000 or $3,000 from income tax, but that self-employment tax was another $7,500. And if you don't set that aside, then April 15th rolls around and you're like, wait a second, I didn't make that much money. I only made 50 grand. Well, you left off the self-employment tax. So the percentage depends upon what entity you are, how you're taxed, and then your individual tax situation. And obviously there's different states, different rates, some cities have income tax. I find a good rule of thumb, and this is just a rule of thumb, is 25%. I think if you set aside 25%, just because you don't know any different, like I'm starting this business, or I've started this business, I really don't know what it's going to look like. If you set aside 25% of the top number, not the bottom number, you're going to be covered. I'm not saying you're going to owe 25% tax. You probably shouldn't, but working with a professional like Core, we can help you figure out what that is and pay it in and reduce it to the least legally possible, and make sure that you don't have any surprises. But if you're trying to do this on your own, 20-25%, you're not going to get in trouble. So back to this first idea. We are a profit first master professional firm. And for those of you who are not familiar with Mike Michalowicz's book, Profit First, I strongly urge you to read it. It is a simple concept and fairly easy to implement, but it is radical in its thinking. And the radical part of it is you pay yourself first, and then you spend what's left over. Now, part of that is taxes, because if you make a profit, you got to pay taxes. Profit first methodology is you have separate bank accounts to allocate those things. And the traditional model is you have an account to put your money into, you have an OpEx or an account to pay your bills out of, you have an account set aside for taxes, and you have an account set aside for profit. So, if you make a $10,000 deposit, a percentage is going to go into the profit account, a percentage is going to go into the tax account, and then the rest is going to go into the OpEx account to spend. The process and the structure of that is that you're guaranteeing yourself profit, you're guaranteeing that your taxes are paid, and then you get to spend the rest. So we can help you with Profit First if you have additional questions on that. One other question we get a lot of is retirement plans for self-employed or small business owners. And there are more than the ones I have listed, but the most common I see in small businesses are a simple or a 401k. Now, the single K is a version of the 401k for individuals and their spouses. So you can't do it if your child works in the business, your parent works in your business, your sibling works in the business. None of that works for a single K. In those cases, the simple is probably makes the most sense. The 401k and the single K give you a little higher dollar limits on what you can contribute. But if you're just trying to do something for yourself, even if you don't have employees, a simple is a good alternative to start with. There are no administrative fees to set them up. Your first couple of years in business, unless you just go gangbusters, you're going to be able to contribute plenty and deduct it for your taxes. You're not going to run into any limitations on that. A question I get around that is, well, can I fund that from my personal account? You can, although again, best practice, have a business account, pay it out of the business. If you're a sole proprietor, yeah, you can pay it out of your personal account, but it just is a lot cleaner if you do it out of the business. I ran into this with a client just a couple of weeks ago where she was a physician and had a W-2 wage, and her husband had a Schedule C business, and the tax preparer had not deducted the single K 401k contribution that they made on that Schedule C. And it's easy to fall through the cracks if all of that data isn't in one place. So that's about it on retirement plans, and that's the end of my scheduled presentation. So I'm happy to take questions if anybody has any general or specific to their business. Be happy to answer them in this forum, or I'll bebop back to the front page and put my email up there. You're welcome to email me, and I'll reply to you in private.
Well, Christian, I know that one question I got probably the last couple calls that I took for prospect meetings was around receipts. Is it kind of a past in the history of the IRS that people had to hold on to receipts and submit those to a accountant at tax time? Or is tracking things essentially digitally through QuickBooks sufficient and they don't have to hold on to receipts? What's kind of the guiding principle on that?
That's a great question. We come from the standpoint that you should always assume you're going to get audited, although most businesses aren't. But if you go through an audit without documentation, or if you've got screwed up documentation or incomplete documentation, you'll never do it again. I mean, it's nasty. So the simple answer to that question is you don't need receipts for someone to prepare your taxes or to file taxes. You just need receipts if the IRS asks questions. A lot of their audits now come in the form of what they call desk audits, which that basically means they're going to send you a letter asking for additional information. That, probably in a lot of cases would require receipts, canceled checks, credit card statements, bank statements, those types of things. So I don't know if that answered your question, Michelle, but
mostly. I think the folks that were asking it were just wanting to know, should I keep receipts maybe more for cash purchases? I spent $50, paid cash for gas.
Yeah, I mean, cash receipts, or even if you use PayPal or Venmo and you don't give that information to whoever's preparing your taxes, it's very easy to lose expenses, right? There is a de minimis requirement by the IRS, which says that if the expenditure, the individual transaction is less than $75, you don't technically have to have a receipt from the vendor. That doesn't mean you don't need documentation. So, I mean, theoretically, you could keep a notebook and say, well, I spent $69 on gas. Well, okay. And you put down the location and blah, blah, blah. That can be accepted as documentation. Receipt seems a hell of a lot easier to me. But that's the rule. If it's under $75 for a transaction, you don't technically have to submit a receipt.
Okay.
I have another question here. What should I do if I don't remember what I selected for my tax classification when registering for my EIN? Great question. I'm sorry, your only alternative, well, there's actually two alternatives. The first alternative is to get on the phone with the IRS. I can tell you that the IRS has been a dumpster fire for the last 2 years, and getting them on the phone is very difficult. We have, as professionals, we have a priority hotline, which we're supposed to get our calls answered first as tax professionals. We wait on the phone for 2 hours. So calling, the 1-800-1040 number, I don't know. Unfortunately, that's not something that is accessible online. You can find out a lot of things about your personal taxes online, not so much on the business, and how you're classified. That's not going to be available online. The second alternative is to file a tax return, and then they'll send you a letter saying, no, we had you down for this. Now, in this situation, let's say you had an LLC and you screwed up and took the default answer and they've got you down as a partnership, and you file a tax return as an S corporation. As long as you filed that 2553 timely, I mean, you can't, you have to file it on time, you're fine. If you just made a mistake in how you registered your EIN, the IRS will give you a pass on that. That's not a problem. But as far as just, finding out how you filed it, if you do it online, it generates a nice little PDF of a letter. So they don't email it to you. They don't mail it to you. You just get it online. Go look through your downloads. Maybe you kept it somewhere, hopefully. Other questions, Michelle?
Well, you kind of went through all the questions that I mostly get. I don't know if you answered it specifically. I know one question that I get often is, when should I consider moving from an LLC to an S corp? Like, is there a specific kind of general revenue threshold that once I hit that, that's when I should consider switching to an S corp? Would I get the most tax benefits out of that?
That's
That kind of
not a
broad.
question easily answered generally, because it depends upon the business. You know, the example that I used was a business that had profit of $50,000 and the W-2 was $25,000. And so you were saving half on that self-employment tax. Well, that may not be a reasonable situation. You know, a $25,000 wage isn't much. If that was a physician's office as a business, or some other type of professional, you know, well, think about, who are you paying 25 grand a year? Probably not many people, right? So, you know, that 50,000 threshold is probably a little low. I think if you get into 6 figures net income, you definitely need to be looking at it. So somewhere between 50 and 100,000. That's not to say that if you had less profit than 50,000, that you couldn't make an S corporation election and it makes sense. It just really depends upon what you do for the business, what a reasonable wage would be, and what the profit of the business is.
Okay, I see. Okay, I'm reading through some other questions that I had seen, if there's anything else that maybe you hadn't answered already.
Nope.
Did anyone else ask? No.
No,
Well,
no one else.
there was one that I know that this lady was in the retail space, online retail space.
Mhm.
And she was asking, do I register with the IRS for federal tax? I only registered here in Oklahoma for an LLC and received my EIN, that I'm not sure if it is also reported to the IRS.
Yeah, so the state doesn't issue employee identification numbers. The state will issue you a, you know, depending upon the state and depending upon how you register, they will give you a withholding number if you've got payroll. They will issue you a sales tax permit, which is a separate number. But the only place to get an EIN is with the feds. And to answer the basic question is, if you start a business, you should file with the IRS and get an employee identification number. I mean, that's just, yes.
Okay. Okay. All right. Well, that, out of the list of questions that I had, I think you answered everything else.
All right. Well, folks, thank you for attending. We will be sending the slides with the URLs. My email again, send your questions. Be happy to answer them. You guys have an awesome day.
Thank you, everybody.